Momentum trading is one of the most active strategies an investor can use. This strategy relies on market volatility and identifying stocks that are moving in a certain direction, or trending. To keep this lesson simple, we'll only refer to upward trends going forward. When a stock is trending, it doesn't move in a straight line. Instead, the chart pattern is made up of many peaks and valleys that look like waves. Momentum traders are like surfers trying to ride the waves to the crest before they break. Let's look at the steps a momentum trader typically goes through. First, they determine criteria for a stock that is trending. Second, they determine how much they want to risk per trade. Next, they identify trending stocks. Then they identify entry and exit points. Next, they place the entry trade and exit trade, or trades. Lastly, they monitor stock movement and adjust exit points as needed. Keep in mind that steps 3 through 6 are repeated for each trade they do. Let's take a closer look at each step. Identifying a trending stock is typically done by looking at charts and performing technical analysis. Technical analysis uses historical price and volume data to try to predict future stock movement. Its success is based on the belief that charts form patterns that repeat over time. We'll save further discussion on this for another lesson. When determining how much risk you want to take on per trade, consider the following. What is your risk tolerance? Someone who has a high risk tolerance is typically willing to accept more risk than someone with a moderate or low risk tolerance. Due to the increased risk associated with this type of strategy, momentum trading may not be considered by someone with a low risk tolerance. How much time can you devote to monitoring your trades? Timing is very important for momentum traders as prices can change quickly. Typically, the more time a trader can commit to managing their investments, the more comfortable they are with the risks. Also, with more time, a momentum trader can have more trades on the go at once. In the past, identifying trending stocks was really time-consuming. A trader would have to perform technical analysis on a chart for each stock to determine if it met the trending criteria. This led to momentum traders typically focusing on a small number of stocks only, which limited their opportunity for profit. Identifying stocks that meet a trader's trending criteria can be easier now. For example, screener tools allow a trader to look for stocks based on their own criteria. This can be used to create a watch list to make charting and monitoring the stocks easier. To learn more about screener tools, watch lists, and charts on WebBroker, check out our lessons in the Learning Center. Once a trader has identified which stock to invest in, figuring out the entry point and possible exit points is next. This step will heavily rely on technical analysis. Finally, we get to placing a trade. To help make managing the trade easier, conditional orders are often used. We'll go over a detailed example later in the lesson. There are many factors that can cause the price of the stock to change direction quickly. A trader that can react quickly to the impact of these factors has the potential to minimize losses and maximize profits even further. Let's see how this works using an example. First, we define a stock as trending up if the price is higher than indicator A and indicator B. For this example, we are willing to assume some level of risk, and we can monitor our investments multiple times a day. We have $50,000 and are willing to risk approximately $1,000 per trade, or 2%. Next, we create a screener on WebBroker to find stocks that have a price higher than indicator A and indicator B. We look at charts for each stock on the list to confirm if there is a potential trading opportunity. We determine that stock ABC1 has just started to trend upward in the last 3 days and appears to be a good opportunity. Continuing our technical analysis, we determined that we want to buy the stock immediately. The current price is $20 per share. Through our analysis, we believe the stock could rise as high as $26 before the trend finishes. The analysis also shows that if the stock drops below $18, the upward trend will fail. We use these price points and our determined risk to figure out how many shares to buy. We already determined that we want to buy the stock immediately, and we want to enter our exit orders in at the same time. We use the first triggers a one cancels other, or FTO, contingent order on WebBroker to help automate our exit strategy. An FTO order consists of a primary order that, if filled, will trigger the entry of two other orders simultaneously. If one of the new orders executes, the other order is canceled automatically. If you want to learn more about placing contingent orders, check out our Order Entry Essentials for Stocks and ETFs course in the Learning Center. A few days later on market open, ABC1 jumps up and is trading at $25. To help minimize your potential for a loss, you change your stop market order to activate at $23 instead of $18. By the end of the day, ABC1 sells off and it closes at $21. Your stop market order activated and you sold your shares at $23. Of course, if the stock bounces back up above $23, we have the potential to make more. As we mentioned at the start of the lesson, momentum trading can also take advantage of stock prices trending downward. This is done by short selling. Short selling involves borrowing a stock you don't own to sell it and then buying it back afterwards, ideally at a lower price. To learn more about short selling, check out the lesson in the Account Types course in the Learning Center.